Hi, everyone. Welcome to our webinar on how US tariff policies is reshaping the future of financial markets and the global economy. So backed by popular demand, Professor Antonio Fatas will give a short presentation on the impact of policy shifts and all the recent volatility. He'll speak for about 20 minutes, and then we will have 20 minutes for Q&A from the audience. So we've already had plenty come in, so thank you for those, but please do use the Q&A box to post any additional questions you may have. Over to you, Antonio.
Okay, thank you, Alexandra. Good morning, good afternoon, or good evening, depending on where you are. It's a pleasure to be here again after a webinar that I did a few months ago. I'm sure some of you were there. And this is a little bit by popular demand and by what is happening out there in the world. Maybe this is not good news that we're doing another webinar 3 months after the one we did in January, but here we are. Now, what I'm trying to do as much as I can is trying to help you and help me as well understand what the future might be. I need to take a little bit of a step back and think about how we got to where we are today and what is it that makes sense going forward. I'll say that with a lot of uncertainty because there's a lot of things that we don't know yet. And I'll be honest when I have to say things that I'm not 100% sure that I know exactly what comes next, but I'll try as much as possible to give you my views on that. Now, let me start a little bit from what I have learned in the last 3 months. Let me make 2 points. The first one maybe is going to be more pessimistic than the second one. What I've learned in the last 3 months, in particular about obviously US policies, is that there's no clear plan. Again, maybe that was something that some of us suspected already, but I think now it's obvious. There's not a logical plan out there that we can analyze, discuss, and negotiate against. And there's also some signs of incompetence, and maybe I'm using a very harsh word here, but that's the word that comes to my mind. By incompetence, I mean contradictions in the statements, and some of the way the policies get implemented are just not what you would expect from a government like the US. Now, on the maybe more positive news, and maybe I don't want to be too optimistic, but clearly what financial markets have done reacting to some of these policies and what the economy is doing is sort of helping keep things a little bit in balance. So we've seen a change in policy, a very sudden change in policy at least 3 times when it came to Canada, when it comes to the tariffs, reciprocal tariffs, and then more recently when it came to the tariffs on computers and electronics coming from China. And in the 3 cases, you see a reaction that comes to either a negotiating party on the other side or the economy and financial markets making noise. Now, let me talk a little bit about these 2 points in more detail so you understand what I'm saying, what is it that I've learned. Now, here comes what I said, there's no plan. If you think about the statements that we heard from the US administration, they've been very much driven by one variable, which is the bilateral deficit that the US has with every country around the world. This is an obsession, obviously, for the US president, but also from anyone around him. This is seen as a sign of countries taking advantage of what the rest of the world does to the US. Now, in the presence of these bilateral deficits, the US has one tool that they're using, which is tariffs. Now, the problem that I have and many economists like myself have is that tariffs are not a great tool to reduce bilateral deficits. In fact, it's not a great tool to reduce the US deficit. The US deficit is a sign that the US spends more than what their income is as a country, the government, corporations, households. And to reduce that, tariffs will not do it. So here we have a tool that is being used in a way that is very unlikely to address the obsession or the variable that seems to matter more to the US. That is what I mean when I say that there's no clear plan, because we're using a tool that clearly is not the right tool to handle the type of objective that seems to be the objective of the US, which is bilateral trade deficits. Now, here comes a little bit the incompetence part as a consequence. So now we're using a tool that is not maybe addressing the right bilateral deficits. But now let's think about how the tool has been used. It has been used very much through the lens of these bilateral deficits. I don't know how many of you have read about it. I'm sure many have, because that was in the news for the last week. The way these sort of reciprocal tariffs were calculated is by taking every country around the world and say, here is a bilateral deficit that the US has with those countries. Let's make use of those numbers to call them the tariffs that they're being applied on US goods. Now, those are not tariffs. Those are bilateral deficits or surpluses in some cases, and they were used to justify a very high level of reciprocal tariffs. And here is where I'm using that word incompetence, because this is something that makes no sense. For example, the tariff of the European Union on the US, on average, is somewhere below 2%. But the calculation that the US government did implied that the European tariff was somewhere around 40%, not 2, but 40. That means reciprocal tariffs became incredibly high. Again, I'm going to show you a picture. Hopefully, you can see what that picture does. It does a calculation of tariffs after the Liberation Day announcement that says, look, US tariffs became way higher than any country around the world, much, much higher than any other tariff that any other country charges to the US. And that's why the market and everyone else sort of reacted in such a way, because these were by no means a low level of tariffs. That was much higher than what everyone anticipated. Now, of course, we took a pause. We took a pause on all countries with the exception of China. Now, it's not a pause that took tariffs down to zero, because tariffs remain at 10% for all countries. So even with the pause and even with the step back, tariffs are still in place and remain quite high by the standards of the tariffs we're used to, and they remain quite high by the standards of the tariffs that other countries apply to the US. And again, that's the inconsistency that I see in the plan and the way it's being implemented. Now, forget about the past. Let's look a little bit forward. So what comes next? So now we have a number of days ahead of us. I think if I'm counting right, we have 84 days left, where in theory, the US has to negotiate with about 180 countries, because this is the number of countries where reciprocal tariff was put in place. So you have to negotiate with 180 countries with an objective which is not very clear, which is, remember, reduce trade imbalances, but we're negotiating tariffs which are unlikely to reduce those trade imbalances. So what is happening today? I'm just picking up some news that I got yesterday in the Financial Times headlines. It says the Vice President of the US, J.D. Vance, predicts there's a good chance of a UK-US trade agreement. Now, that trade agreement is around tariffs, as you see on the second line. But again, if you take a step back, the UK tariffs on the US, before whatever negotiation is happening, they were very close to zero. Yes, there were some goods out there where tariffs were slightly higher for many reasons. Sometimes it's agriculture, sometimes a particular product. Again, it's always a good reason, otherwise the tariff will be zero. Removing those tariffs will be really a minor impact on the world economy. It will be a minor impact on the trade between the UK and the US. It will not reduce by any means the bilateral deficits. So now we're heading into a world or where I'm going to call cosmetic agreements, cosmetic wins. So there's going to be a statement here and there occasionally that an agreement has been reached that will look like tariffs have been reduced somewhere. But again, we're talking about very small tariffs for a particular set of goods, agreements to buy certain goods in the future from the US, more planes, more defense goods, or whatever the agreement is. But we know that those agreements, because we saw them in 2018, many of them, they don't end up taking place and they don't change at all the bilateral deficit. Now, one might take an optimistic view and say, well, it doesn't matter. It might be cosmetic, but at a minimum, we're sort of going back to business as usual. We're leaving tariffs behind. Maybe. The question is when? When will we be done with this process? Now, if I have to make a prediction, I doubt that in 84 days, the US will find agreements with 180 countries. There will be some countries that will be faster, that will have more power on the US to find an agreement. But the reality is many countries will be left behind. So in 84 days, which is still 3 months of uncertainty, we're still going to be left with a large amount of uncertainty. Now, uncertainty hurts. Uncertainty is here already. I've shown a picture like this when I was doing a webinar 3 months ago. This picture is different because uncertainty has increased even more today relative to where we were 3 months ago. Now, when you look at uncertainty measures, there's a few of those. You look numbers which are as high as during COVID, and they are much higher than during the global financial crisis. Now, I don't think I need to tell you this because you read the news as much as I do, and there's a lot of things happening which are surprising, and many of us look at a future without being 100% sure what comes next. Now, let me move from that statement, which was mostly about tariffs and policies, and let me talk about what financial markets did. Let me try to help you understand what financial markets did and what they might do going forward, given that they seem to be important. And then I'll wrap up everything and talk a little bit about sort of the economic outcomes out of tariffs and also the financial markets. Now, what have we seen in financial markets? Obviously, there's been a very much a reaction that says, look, this is a surprise. It's a surprise to see US policies to be erratic, US policies to be aggressive, and the idea that the US was always sort of a point of reference during crisis, that people thought about US assets as safe assets is being questioned. Now, it's being questioned in several markets. Let me start with the exchange rate. So this is sort of the US dollar euro exchange rate. I'm sure many of you know what has happened over the last days. So if I look at sort of within this year, 2025, the euro has been going up, the dollar has been going down. If you look at the numbers from 1.03 to 1.14, which is the value today, we're talking about a 10% depreciation of the dollar. Some of that depreciation happened with the announcement of these tariffs, and this clearly sent a sign that someone around the world, some foreign investors, are moving away from the dollar. Now, let me take a little bit of a step back and give you some perspective. Yes, this is what happened, and this is a sign that maybe the US assets or the US dollar is being questioned as a safe asset. At the same time, let's not forget the history of this exchange rate. So this is the history of the dollar-euro exchange rate going back to the day the euro was launched, January 1st, 1999. Now, what you've seen in my previous slide is that a small blip at the end of my slide. That is not a big change in the exchange rate compared to many episodes we've had since the creation of the euro. And again, if you go back in time, let me remind you that before the global financial crisis, the euro-dollar exchange rate was 1.6. So you have to pay me $1.6 to buy 1 euro, which is very far from the value of where the euro or the dollar is today. Now, what do I see here? I see that in the last days, yes, exchange rates have moved, but it hasn't been too dramatic. At the same time, I see something else. There's a long way to go. So if you want to think about the future, again, we could now see a drift of the euro up or the dollar down that could take us many months in terms of a drift in that direction, and potentially could go to levels which are a lot higher than what we see in this slide. So not a lot of action yet, but if you want to think about potential volatility here, as much as you want, a lot more than what we've seen in the last week. Now, there's been a lot of action as well when it comes to government bonds and the yields on those government bonds. And obviously the reading is the same. As people move away from US assets, they move away from the sort of most relevant and safest US asset that we can think of, which is US government debt. Now, if you look at US yields over the last days, here I really have just 1 month, the month of April, or half a month, you can see that US yields have increased. Now, they did not increase the day of the announcement of the tariffs. They increased in the couple of days that follow. Now, if you look at the increase, it is significant. We're talking about half a point for either 10-year yields or 30-year yields. That is not a small change over a short period of time, a couple of days. At the same time, I do want to give you a perspective, which is the yields that we're seeing in the last days are not dramatic yet. So as much as there was a lot of talk about the market panicking up to a point, because if you go back to, let's say, 2024 or even earlier 2023, we had seen yields in both of these assets that were higher than what we've seen over the last days. So same message as with the exchange rate. We've seen movements in yields. We sort of match our intuition that there's been sort of a movement of investors away from US assets. They've been significant if you think that they happen over 24 hours or 48 hours. But if you look at the levels, those levels are not yet particularly alarming because we're talking about yields which are still contained by the standards of what we've seen in this case in the last 2 or 3 years. Now, let me make a point about about these numbers, which might be a little bit more interesting and insightful. Yes, the movement in exchange rates and yields have not been that large. At the same time, there's something unusual, which is a little bit of a concern if you think about US assets. When yields went up during this last week, we've seen the exchange rate depreciating. Here I have the euro dollar. Going up means the euro goes up, the dollar goes down. Now, that is very unusual. It's very unusual to see interest rates in the US moving up at the same time that the exchange rate, the US dollar, goes down. Typically, they move in the same direction. Now, if you want to make a story about why is it so unusual, is because this time you truly see investors moving away from US assets. The numbers are not dramatic yet, but the correlation that you see here signals that something is different. Something is different from some of the changes I've shown you before, which might have been as large as this one, but we never saw a correlation that looks like this, people moving away from bonds at the same time that they move away from the dollar depreciates, the yields go up. Now, let me sort of think a little bit about the word panic, because we use the word panic here, and we can use the word panic in many ways. Now, if I think about the word panic, there's two ways to think about the word panic. One is that markets are going through a liquidity crisis. Now, what does liquidity crisis means here? That there is some trade that is causing some markets to sort of freeze. Now, there's a lot of talk about basis trade. There's a lot of talk about, again, some of the spreads sort of getting wider. Now, in that environment, what you typically do is you call for the help of the central bank. So if we see some of this panic in financial markets as panic in terms of liquidity, I would say, let's wait for the central bank to come and save the day if they have to. The central bank has not shown up in this last week, but if that panic in terms of liquidity were to happen over the coming weeks, I'm quite sure and quite reassured that the central bank, the US Federal Reserve, will come. There's a second level of panic, which is a lot more concerning, where the central bank cannot show up. And that is when investors do not trust the US government and they do not trust US debt as a safe asset. That is a lot more concerning. Now, let me talk a little bit about that. Let me talk about US government debt because it's part of the story of what is happening to yields today. Now, we've been worried about government debt sustainability in the US and in many other countries around the world. As government debt has exploded, has increased, we've worried about that. Now, typically, when I think about government debt sustainability, when I talk about this, teach about this, I typically tell participants, students, to focus on things like this slide, which is, what is the burden of this debt? What is the amount of interest that the government has to pay to sustain the debt? So these are interest payments of the US government associated to US government debt going back to 1960. Now, when you look at this data, I want you to see the following. For 20 years, since the year 2000 until 2021, the US government debt burden was quite low, around 1% of GDP. That was not because the debt of the US government was not high, because it was high. It was because the interest rate in which we live used to be very low. Now, we've seen in the last 2-3 years that the debt, the interest payment, has increased as a result of increases in interest rates. This is not the last week. This is the last 2-3 years. Now, what is the rest that you see here? The rest that you see here is a projection done before the Trump administration. This has nothing to do with tariffs, has nothing to do with last week. This is a projection that says if the US government continues with the current tax laws, so look at the laws as they are today, spending and taxing, you're going to see interest payments increase as much as this. There is no assumption here of interest rates exploding. It is just the dynamics of taxes and spending in the US generating more debt. That debt obviously needs to be serviced, and interest payments very much doubling over the next decades. Now, when you look at this picture, when I look at this picture, this is not sustainable. I cannot imagine the US government spending 6% of GDP just on interest payments. Now, here is where I see a source of concern, because if investors look at this, now this is something which is much bigger than tariffs, in my view. They see a path for government debt, which is not sustainable, whether this is the US or any other country. Now, what is the government sort of doing to address this? So on one hand, the US government today has this big plan under the label DOGE, the Department of Government Efficiency, which is to try to contain spending, in some cases, some radical plans to save trillions of spending out of the US budget. Now, as we speak, again, we're not done, obviously, with the actions of the current administration. As we speak, if you look at the path of spending over the last 90 days in the US under the Trump administration, it looks very much identical as the last 2 years under Biden. So spending has not decreased in any meaningful way. In fact, there is 154 billion more of spending this year than last year. So I don't see a sign yet here that there's any containment of spending. Now, the biggest concern is when it comes to taxes. Now, the budget has not obviously yet been put in place, but the current discussions we see in the Senate, there's already discussions over the budget. The current statements made by the US government is that the temporary tax cuts that were put in place a few years ago are becoming permanent. And there's going to be additional tax cuts that are going to reduce the tax revenues of the US. Now, I borrowed this picture from a conservative think tank. This is not a group of liberals trying to be critical of Trump. This is very much a conservative think tank that worries a lot about their sustainability. They just came out with a projection that says, imagine these discussions in the Senate become policy. Okay, they might or they might not, but imagine they do. The path of debt for the US will be such that debt will double over the next decades, which is a lot more than the previous forecast we had made before we were having these discussions that said debt was only going to increase 50%. Again, if these discussions end up in a budget that looks like serious tax cuts and an explosion of debt, I do see here a little bit of a least trust day. I don't know if all of you remember what happened to Liz Truss in the UK, where she approved a budget and the markets really reacted very strongly against that budget. So I see something here possibly happening, which is a moment where there's a reaction to US debt that goes beyond what we're seeing in tariffs, which is much more about the true structural imbalance of the budget. Now, let me say a few words about how do I put all of this together. The uncertainty coming from tariffs, where I just say about financial markets and government debt. So I'm going to look forward. I put in brackets, not looking forward, because it's going to be a little bit on the pessimistic side. The uncertainty that policy is creating, in particular tariffs, I don't see it going away. I see companies slowing down, taking a pause, not hiring, not investing, and this is not going away soon. I do not see the world going back to business as usual anytime soon, even after 90 days of negotiations. So I see lower growth and I see higher inflation ahead. If you look at some of the recent surveys in the US, there's this sort of Michigan survey of consumers that gets quoted all the time. If you look at consumer sentiment, which is on the left, is plummeting, is as low as it has been in recent years. If you look at expected inflation, it's increasing. It might be that these surveys are not right and inflation ends up being lower than that, but you can see this is already having an effect on the views of consumers and firms about the future. This is likely to translate in lower growth and some high inflation. I don't think financial markets will become over the coming weeks, months, or years. I think interest rates will continue to be volatile, in particular if you bring the argument that I just brought up when I talk about government debt potentially increasing or exploding if we don't take control of it at some point. I think the stock market is way too optimistic. I know that the stock market has come down a few days here and there, but from my perspective, it remains very, very expensive by historical standards. in a world that is very uncertain, where there's a lot of risk, and I do not expect the stock market to look what it looks like today if I put together all the macroeconomic fundamentals. In addition, uncertainty, as I say, is not going to go away. I expect many more surprises coming over the next months. Yes, even if we're done with the tariffs, which I don't think we are, there's going to be other policy decisions, whether it's about who's the next chairman or chairwoman of the central bank, whether it's about the membership of the US into the IMF or the World Bank, which is up for review in a few months. We're going to hear surprises which might not be as dramatic or might be more dramatic than what we just went through with tariffs. Again, that to me creates an environment of high uncertainty and in some cases some bad news when it comes to growth or inflation. And then there is the idea that is getting bigger and bigger out there that we're moving to a new world, a new international order where the US is going to play a very different role from before. That means that we all need to adjust, and all needs companies, governments around the world. I cannot imagine that adjustment to be easy. Yes, we're not going to adjust in a week or in a month or in a few years, but slowly we're all going to start moving our sort of strategic plans for the long term in directions that were different from before. And that is going to create some cost in the short term, which is not going to help the environment for the next 12 months or the next 24 months. Now, let me stop with my pessimistic view, and I'll bring Alexandra back, and then we'll do the Q&A and answer some of the questions I've seen you're posting.
Excellent. Thank you very much, Antonio. Lots to dig in there. I guess one question was, could you elaborate a little bit more on why the tariff policy won't reduce the deficit?
Yeah,
just the reasons behind that.
Yeah, so I mean the main reason is, again, a trade deficit means that the country spends more than what they earn. It's as simple as that, and it's true for the US or anyone else. Now, who's a country? A country is the collection of governments and the private sector. Now, when I talked a second ago about the government deficit and government debt, that's part of the trade deficit. So what could a US government do to reduce the trade deficit? Reduce the government deficit. That will work. That will be automatic, and it will work because it always does. But that's not what I see. I don't see the US government being willing to reduce that deficit. If any, I see the opposite. So to me, it doesn't matter how many tariffs you put, as long as the US government deficit remains high or higher, there is no way for the US economy to run a trade surplus, unless the private sector also reversed and said, we've been running deficits for the last 3 decades. Now we're going to run a surplus tomorrow because of a couple of tariffs here and there. That's not how it works. And tariffs affect exports, affect imports, affect companies, affect sectors, but they don't affect fundamentally those bilateral deficits.
Thanks. And so could you talk a little bit about how you see China reacting and the sort of fallout in China in different regions of the world?
Yeah, I mean, China has done something which I find, I mean, it's interesting. I think we're seeing some of these things for the first time. China has said, look, I'm not going to be quiet. I'm going to push very hard. Again, we've seen China make statements about we're going to stop selling some critical goods to the US that the US needs. Again, that's a very strong statement. We're not going to buy planes from the US anymore. That's a very strong statement. And I think what they see, which I think is a fact, if you're very tough with the US administration, they fold. Canada was very tough. When the first tariffs came around, Canada said, I'm sorry, we're going to do the same thing to you. And the tariffs were pulled back. China was very tough. The rest of the world, some of countries have been pushed back and the tariffs were taken back. Some companies have been complaining and say you cannot have tariffs which are this high. And some tariffs, again, were postponed, at least for a while, tariffs on computers, electronics. So obviously these companies must be powerful enough to change the policy of the US. So I think China is playing that game. I think they have more power than the US has on this negotiation. China could go through a lot of short-term pain just to make sure that they win this battle. I don't think the US can. I think if the US economy enters a recession, I don't think Trump will have the political capital to say, it doesn't matter, we're going to keep going through this. What we saw in recent weeks clearly is if he sees the economy getting weaker, either himself or the people around him are going to fold. And China knows that. And China knows that they can do a lot more than Trump when it comes to sustaining short-term pain. So to me now the question is the dialogue is going to start, if it hasn't started yet, and what are the cosmetic sort of agreements that one can do between China and the US so that the US says, we've won, and China says, you can say whatever you want, but we haven't changed things that much.
And in terms of the impact on Europe and other economies, emerging markets, what do you see happening there?
So I think Europe is going to play the same game. Again, right now they're negotiating because there's no tariffs on Europe except for that 10%, which is not small, but it's not as high as the 20 plus that we had before. So I think they're negotiating, once again, hoping that this goes away. It could be that the US decides to be tougher on Europe because they need to be tougher on someone just to show that they still care about these things. And it could be that Europe has to truly show how tough they can be on Europe. And for that, sorry, on the US. And for that, Europe needs to be unified. I think that's the risk in Europe, that not every country speaks with the same voice. And here you need that power that says we're speaking with the voice of a really large economy that has a lot of power against the US. I expect to see the same thing on the US side. If Europe becomes really tough on the negotiations, I think there will be an agreement or there will be another postponement, another renegotiation, another extension for another 90 days if we have to.
And do you see a sort of situation of more bilateral agreements, new trade blocs forming, or do you think the WTO can still play a role, or how is that shifting?
I mean, I think what has happened in the last week is a little bit sort of we're moving into a new world. Yes, there's still something that we call the WTO out there, but no one is playing by those rules anymore. The US is making the excuse that this is a national security emergency, therefore I can do things that the WTO tells me not to do. You can take the US to the WTO and complain. This is going to take years to be resolved. It doesn't matter. At this point, all countries, all companies are thinking, do I want to continue trading with the US? Do I want to shift my trade to a different market? I do think there's a lot of questioning whether the US will be in the future a reliable partner, whether this is just sort of an anomaly caused by a particular president, or there's something deeper that might continue over more than one administration, in which case you need to change your views about sort of what is an ally, what is a reliable partner when it comes to these trade negotiations.
Do you see the US dollar losing its status as reserve currency?
So let me give a little bit of context to that question, because I've been asked that question many times. Again, for anyone in the audience who's been in my class, they probably have seen me answering this question. And I've always said the same. It will not happen soon. It will not, because there's no alternative. So we can criticize the US, we can criticize the way the US uses the US dollar, but at the end of the day, that's what we have. The US dollar will continue being the main currency of the world. Now, in the last weeks, I've changed my mind. I've changed my answer. Now what I see is there is a strong incentive for every country in the world to move away from the US dollar. I don't mean in the short run, because in the short run, you have to do what you have to do, and the US dollar remains the center of the financial system in the world. But if I'm a country which is not the closest political ally of the US, now I'm really worried that I'm going to be put under sanctions. And because the US controls the US dollar, they're really going to have an effect on me. But that applies now to many countries around the world that they don't see themselves as close of a political ally as they used to. Again, I was reading the other day some statements from some sort of European politicians saying, we do not see the US anymore as a political ally. That might be a little bit too extreme, but again, we all understand what that means. It says the perspective is very different. So we're going to start moving this sort of big oil tanker. It takes a long time to shift in a different direction, but we're going to be shifting away from the US dollar. And it's going to happen at the beginning slowly, and at some point it might accelerate it in a way that is very visible.
Mm. And in terms of the sort of, so investors move away from the US, where are you seeing them move into instead? Like what should we be investing in?
So I think that's a tough question because, again, the US has been such an attractor of capital, an attractor of attention for a good reason, because there were many companies in the US that were very successful over the last years or decades. And it was very hard to find sort of an obvious alternative. Of course, there's been investment everywhere in the world that has paid great returns, but there was not a big country like the US that was an obvious focus of attention for investors. Now, Europe has not delivered as much as we thought it would, partly because it's a collection of countries, not quite a country, partly because the euro maybe has failed to live up to some of those expectations. So I don't have an alternative that says, if you move away from the US, you go to, if you move away from the US dollar, you go to. The obvious alternatives in terms of currencies are the euro and obviously the Chinese renminbi, the Chinese yuan, because those are the big, large blocks that in principle could be a competitor. Now, China has been very, very careful opening up their capital account, their capital flows to the rest of the world. That means that they're hurting the possibilities of their currency becoming the currency of the world. But that might change as we speak, because now China might see an opportunity and say, well, let's change our policies. Let's open up to the rest of the world. The rest of the world is
Mm,
really happy finding an alternative to the US dollar. Why don't we take that place right now? So it's going to be a race between Europe and China. I don't see a clear winner in the short run. So we're going to see a lot of bilateral agreements and sort of blocks here and there that will try to create sort of a small islands where maybe a currency is being used. It could be the Chinese currency, it could be the European currency. There might not be an obvious replacement to the US dollar for a while, but as I said, we're going to be moving in that direction.
mm. And how do you expect different central banks around the world to react now and going forward?
I mean, I think central banks in the short run, they're going to be worrying about crisis. They're going to be worrying about financial market instability. That's the number one concern. Again, we saw it a little bit in the US this week, although the central bank didn't have to intervene. I expect to see more of this in different countries, including the US, over the coming weeks or months. So that's sort of the short-term concern for central banks. Now, in the medium term, long term, they're going to worry a little bit about inflation because, again,
Mm,
inflation, we just defeated that spike of inflation and it took a lot of effort. And some central bank were hit on their credibility, not too much, but a little bit. So now they're looking at a world where maybe inflation is coming back and they really need to be very careful that people don't say, wait, you told me that that was a one-time event, that what happened after COVID will never happen
mm,
again. And now we start seeing inflation again. So I expect them to be quite tough when it comes to inflation if it comes back, whether it's the US, whether it's Europe, whether it's other emerging markets. I think they're going to be quite tough because they do not have the ability or the capacity to lose again some of their credibility after we just went through a spike in inflation.
mm, mm. And do you see, so could a weaker dollar actually be better for the US? There's been a bit of sort of discussion around that. What's your sort
Yeah,
of view?
I mean, it could be better for some sectors for sure. The dollar has been, historically speaking, has been recently quite strong. So again, if you
Mm,
look at the exchange rate that I've showed you earlier, the dollar has been quite strong. For sure, some companies, some sectors in the US do not benefit from a dollar which is strong. As it gets weaker, again, some sectors will be able to export more for sure. But again, let's not forget currencies go in both directions. There's also what you buy from other countries. So if you buy some critical goods from other countries, as your currency depreciate, those things become more expensive. And that is going to hurt importers of those critical goods that maybe are exporters to other countries. So some companies might become less competitive as the currency depreciates. My view on currencies, yes, they do affect growth, they do affect exports and imports, but a little bit less than what we think. They do move
mm,
some sectors, but in the aggregate, I do not expect this to show up significantly in terms of GDP growth in the US.
mm. And sort of looking longer term, what of all this do you think is sort of reversible and what's permanent, irrespective of, if like at the point that we get someone after Trump who wants to sort of go
Yeah.
back.
Yeah, I mean, I think what we witness, I think it's dramatic enough and traumatic enough that it's gonna stay with us for a while. This is a little bit like when you have a big crisis. When we had the global financial crisis, we all understood how much financial risk matter, how much bubbles matter. And for many years after the financial crisis, we could only talk about that. Every 5 seconds we thought, oh, here there's another bubble. Oh, here is again the financial markets doing something weird. So even if it doesn't happen, we're still gonna be worried about what we just went through. Now, my fear is that this is even more permanent than what I just said. It's not just our psychology that is gonna keep us awake. I do think what you see in the US from a political point of view might last a lot more than the next 3 years. Then it could be that the next president is not that different from Donald Trump, and we have a very similar attitude. Even if it flipped to the other party, we've seen it when the first Trump presidency was followed by Biden. Biden did not stop the tariffs on China that Trump had used in his first term. And I think that gives you that sense of sort of there's a lot of inertia here. There's a lot of inertia because certain policies, they might not be great for the US economy, but they stick around. So I do have a sense that this is going to be longer than this year, and it might be longer than the next 3 years.
We have one question from Stéphane Foucault, which is, how does a potential further deterioration of the US dollar versus other currencies impact the level of US debt?
So it doesn't that much because the US borrows in its own currency. So movements in the exchange rate do not affect the sort of the debt of the US relative to the rest of the world. It affects more other countries because other countries might borrow in US dollars, and therefore when the US dollar moves down, their currency goes up. But in principle, to the other countries, that's good news because if you borrow in US dollars and the US dollar goes down, that means it's easier to repay your debt. So I don't worry too much about implications on debt for the US dollar moving because, again, in particular for the US, it doesn't change at all the value of the debt.
Okay, and one question from Yu Zhang, is gold a safe asset to invest in?
I mean, gold is a safe asset as long as you believe that it's a safe asset, and a few other people believe that as well. Again, gold does not have any fundamental value that says it has to be a safe asset. But if at times of risk people buy gold, the price of gold will go up. Now, if you look at the market for gold, is very volatile. Yes, sometimes it goes up at times of crisis, sometimes it goes down. And sometimes after going up, it crashes dramatically because people feel we don't need a safe asset. So I would be very careful putting any label on an asset that per se does not have any fundamental value or property that says this should be safe. But then it's a question of history. If people believe that it's a safe asset, sure, it might go up at times of crisis.
And we had a couple of questions around, how much China holds US debt and how much they can use that as a leverage in this trade war. What's your sort of view on that?
So out of the things to worry about, that would not be the biggest one I worry about. First, the holdings of government debt by foreigners have been decreasing in recent years. So in recent years, we've seen an increase in holdings of US debt by domestic investors, by Americans, not so much foreigners. It is true that about maybe 30% of the US government debt is held by foreigners, not China, foreigners around the world. Now, if China were to dump all that debt, sure, in the near term, it would put pressure on interest rates in the US for sure. But again, if that caused any sort of financial crisis, liquidity crisis, I would expect the central bank of the US to intervene and buy some of that debt if they need to. And to me, the big question is not what China does with the holdings of debt today, is the future. Will investors in China, in the US, in Europe, will they be willing to buy the future debt that is going to be issued going forward? That's to me the key question here. And as I showed you some of those pessimistic numbers, I have a concern that maybe one day this is not going to happen, and that is going to have a much bigger impact on the yields of the US government than whatever China does with the stock of debt that they have today.
Okay, thank you very much. Sadly, that's all we have time for, but thank you so much, Antonio, for your insights. Thank you to all of you for joining and for your questions. I'm sorry we didn't manage to get to all of them. But if you would like to continue the discussion, but this time with more of a geopolitical slant, please join. So Michael Witt will be holding a webinar on May 14th. And that'll be focusing more on geopolitics. So thank you to all of you for joining, and have a great day.
Thank you, everyone.
Bye.